Okay, so let me introduce my colleagues, Steve Brudos and Brandon Hellenbrand. Steve and Brandon are portfolio managers and have both been with the firm for over 10 years now. Steve specializes in fixed income markets, while Brandon specializes in equity markets. Along with the rest of the team here at TrustPoint, Steve and Brandon are key contributors to the research process and the ongoing management and monitoring of clients' portfolios. So Steve, Brandon, welcome, and thank you for being here this morning. So I'd like to start our conversation this morning by first reviewing the recent performance of both bonds and stocks. So Steve, let's start with you. Give us a recap on how bonds have performed recently.
Sure, thanks, Yan. While the outlook for future returns for fixed income does look very good, the process of getting there recently has been somewhat trying for many investors. Over the last few years, we've seen quite a bit of volatility in interest rates. We've had the 10-year Treasury trading as low as 1% in early 2021 and really as high as 5% last October. Even with that extreme upward movement that we've seen in rates, if you look at the 5-year returns in the middle chart, they're only slightly negative out of most fixed income asset classes, and the negative returns are out of the most sensitive asset classes to interest rates. So that's namely treasuries, mortgages, and the U.S. aggregate index. Returns over that time period are positive for shorter term bonds, which are less sensitive to interest rate movements. So we have been, heavily allocated to high quality short-term bonds, which have posted a positive return over a quite difficult rate environment. Also, if you look at munis and other areas of credit such as investment grade corporates, high yield corporates shown towards the bottom of the chart, those have done pretty well with strong returns over all time periods. And the longer term 10-year numbers, they're all positive with the exception of international unhedged bonds, which are down slightly. And if we look longer term, the income component of fixed income, has offset the shorter term negative price impacts from rapidly rising interest rates. And it's really been, the Federal Reserve's restrictive monetary policy, which has been kind of the main driver of trailing returns. And if you move to the next slide, that kind of illustrates the aggressive path of the Fed funds rate. And this chart does put the move in perspective a bit. If you look from early 2022 to July of 2023, the Fed funds rate went from essentially zero all the way up to 5.38%. So this was after more than a decade of zero interest rate policy. So the current Fed funds rate, which is above 5.3%, is at the highest level in over 20 years. You have to go all the way back to 2001 on this chart to see a similar Fed funds rate. So what's important here, though, in a takeaway is that, most of the upward pressure on yields on interest rates from those rate hikes should be behind us. The dotted lines on the right side of that chart show the expected path of the Fed funds rate later this year and into next year. So really, unless inflation starts to turn back higher, the Fed is expected to cut rates at least once by year end and kind of continue with that easier policy as we move into 2025 as well. So we'll get to it later, but this stage of the cycle where the Fed kind of turns from rate hikes to pricing in rate cuts has historically, provided a tailwind for bonds as a lot of upward pressure on interest rates tends to ease with a falling Fed funds rate.
Well, thank you, Steve. Let's move on to stocks now. So Brandon, what can you tell us about the performance of equity markets over these same time periods?
Yeah, thanks, Yan, and good morning, everyone. On the next chart, first, if you just look at global equities on the top, stocks have offered strong returns in each of the time periods shown, with a 10-year average annualized return nearly 9%. Breaking down the equities into each of the sub-asset classes, you'll notice that over the 1, 5, and 10-year time periods, U.S. large cap and specifically U.S. large cap growth have offered the strongest returns. Other subclasses like U.S. small cap and international near the bottom of the charts have only offered modest returns over these time periods. The main catalyst for the strong returns for the U.S. large cap growth have been the concentrated returns of the 7 U.S. tech stocks, or the Magnificent Seven, as the industry is now calling them. And on this next chart, you'll see that since the start of 2023, the U.S. stock market, as shown here by the S&P 500 in green, is up over 30%. The Magnificent Seven stocks, shown here in blue, on average are up over 160%, contributing nearly half of the returns of the S&P 500 index and bringing their cumulative weight in the index to 30%. These 7 stocks are major parts of every diversified investor's account, including our clients' portfolios. But having over 30% of a U.S. equity portfolio in just 7 stocks would create a concentration risk. As a result, though investment portfolios have experienced strong returns since 2023, many have lagged the returns of the S&P 500. And this isn't just a U.S. issue either. The Mag 7 stocks make up over 20% of the global market cap.
Well, thank you, Brandon. It's quite amazing that the majority of the returns has been really concentrated, as you said, in the minority of stocks. So, to your point, that has led to concentration risk in many major indices, especially in the U.S., that we as money managers have to be aware of and manage to make sure, again, that our clients remain properly diversified at all times. I'll ask you in a minute, Brandon, to explain what has led to the outperformance of the Magnificent Seven. But before we do that, I want to elaborate a bit more on why U.S. stocks in general have done so well relative to international or even emerging market stocks. So we'll move on to the next slide here. We know that over time, economic growth, earnings, and stock prices are positively correlated. It's not a perfect correlation, but a positive one for sure. U.S. economic growth, shown by the black line here in the chart at the top, has not only surprised to the upside in the past few years, but has also surprised what we've seen elsewhere in terms of growth. But the question is, why? Why, in the face of the fastest monetary tightening cycle since the 1980s, U.S. economic growth and U.S. earnings and stock prices have performed so well compared to other regions? So to start with, it's the consumer. So the consumer, the U.S. consumer, has been doing what it does best, which is spend. So the chart here shows that U.S. consumer spending has meaningfully contributed to GDP growth for many quarters now. But you may ask, how? How have U.S. consumers been able and willing to spend in the face of rising and now high interest rates and shrinking credit access? Well, to start with, we have to remember that U.S. consumers accumulated over $2 trillion savings during COVID. And that was a function of fiscal transfers and the inability to spend as consumers were stuck at home. But the reopening of the economy since 2021 has really allowed consumers to tap into these excess savings, supporting obviously consumption and the broader economy. And more recently, as excess savings accumulated during COVID and now close to being depleted, what we call the wealth effect has helped U.S. consumers. The feel-good effect of having a job with solid wage increases, rising stock prices, rising home prices, and rising income on savings as well. Arguably, now there are plenty of indicators still suggesting some deceleration in spending ahead. If you just look, for example, at the last reports from some of the big U.S. companies, including McDonald's, Target, and Walmart, just to name a few, they have indicated that low-income consumers are increasingly getting hit hard by high prices and high interest rates. Now, they mentioned that US consumers are no longer buying the things that they don't need and are increasingly looking for bargains. And more broadly, when we look at data points like payroll, and we're seeing slower payroll growth, we're seeing a pickup in delinquency rates. So that point in the direction of slower consumer spending ahead, but so far, so good for the US consumer and the US economy. And the other point that I would like to mention relates to fiscal spending. That's the other contributing factor to solid US growth as of late. Now, if you just look at the last few years, pieces of legislations like the Infrastructure Investment and Jobs Act or the Inflation Reduction Act and the CHIPS Act have all provided additional fuel to the economy. And all of those are good examples of public investments in high technology manufacturing, clean energy infrastructure that have helped the US economy grow above expectations and grow again above the pace of growth we've seen in other regions of the world. Now, these investments could well raise productivity, expand the capacity of the economy, and even reduce inflation in the long run. And that's all positive. But on the flip side, these investments have also led to larger and larger budget deficits, which long term now could create stability risk for the US and even the global economy. And that's a point that the IMF has recently flagged in its latest report. And the chart here, I think, shows the extent of what I'm talking about. It shows a close correlation or close relationship over time between the unemployment rate, which is the black line, and the budget deficit, which is the blue line. And historically, what we've seen is fiscal spending being used as a mechanism to stimulate growth in the economy during tough times. So when the private sector was struggling and jobs were being lost, the federal government would step in to provide a cushion under the economy. And through increased government spending, tax cuts, or a combination of both, budget deficits, again, the blue line on the chart here, would rise when the economy was struggling and the unemployment rate was also rising. In the last 10 years or so, that has changed. Fiscal spending has become common, widespread, regardless of how the economy is doing and regardless of who is in power. And it's not just at the federal level. If you look at the state and local governments, they're still sitting today on nearly $240 billion in federal COVID grants that they must spend. And in our opinion, the upcoming November election won't change the trend here, especially if there's a unified government in Washington after the November election. So we'll turn it over to you, Brandon, and I'll ask you a question when it comes to the economy and earnings. Should the U.S. economy remain in an upswing over the next year or so, how would that translate into earnings?
Yeah, so should the economy remain in a cyclical upswing, we would expect earnings growth to broaden beyond large caps and the Magnificent Seven stocks. When looking at current analyst expectations, as shown here in the chart, you'll see that earnings growth in 2024 is driven primarily by the Magnificent Seven and large cap stocks. But earnings growth is expected to broaden in 2025 with small caps leading the way. This upswing in earnings for the broader market should attract investors' attention, and we'd expect stronger returns from mid and small cap companies relative to large caps going forward.
So obviously lots of talk about artificial intelligence and how this technology has positively impacted the stock prices of the Magnificent Seven recently. More broadly, what impact do you think AI may have across the entire economy going forward? So what are your thoughts on that?
Yeah, so it's certainly still early, but signs are pointing toward a fourth period of elevated productivity growth from new technologies, this time from the adoption of data era technologies like AI and cloud computing. Early market winners include hyperscaler companies that have easy access to data and cloud computing technology like Microsoft, Google, Amazon, and Meta. These companies have been buying computing power from semiconductor companies, mainly NVIDIA, and building massive data centers to house the computing. With help from the fiscal spending, from the Inflation Reduction Act and the Infrastructure Act and the CHIPS Act, a wave of new AI-related manufacturing has started, which is also benefiting companies beyond technology like industrials, building materials, the data center REITs, and more recently, utilities. So the high productivity growth will benefit the entire economy and likely lead to higher profitability of companies as well. The next slide will help to illustrate this point. So this is an estimate from Goldman Sachs, where widespread adoption of AI technology could boost productivity by 1.5 percentage points per year over the next 20 years. As the red line shows, this would lead to higher corporate profits relative to the baseline in earnings per share, increasing the compounded annual growth rate of earnings by 0.5 percentage point. So we know that profits drive stock prices, so this would be a benefit that investors would feel as well. So overall, AI technology would be a net benefit for the global economy, similar to past technological breakthroughs.
All right, Steve, let's bring you in the conversation here. Brendan just discussed the potential impact of AI on productivity, growth, and earnings. What are your thoughts on how AI may impact inflation going forward? We know that the Fed has been in a battle against inflation for 3 years now. Could AI potentially help the Fed? If you could share your thoughts on that and maybe more broadly on inflation in general.
Sure. Over the shorter term, we're seeing the adoption of artificial intelligence. It's requiring, substantial investment in AI infrastructure, also, high-skilled labor, right? That's capable of developing it. So this could initially, lead to some higher costs being passed on, to consumers through higher prices. However, there is a leading school of thought out there is that artificial intelligence will, ultimately lower labor and lower production costs through increased scale and increased productivity. So this, would be disinflationary over the long term. But again, we're just in the early stages of artificial intelligence, as Brandon has mentioned. More broadly, and Jan, if you want to move on to the next slide, the Fed's aggressive rate hike path while keeping the Fed funds rate at peak levels for nearly a year now has really made substantial progress bringing inflation down. On this chart here, it shows the consumer price index, so that's known as CPI in blue and core CPI in gray, which excludes, the more volatile food and energy measures. So both of these measures are widely followed by economists, by investors, and they've really fallen from peak levels of 9.1% and 6.6%, all the way to about 3.4 and 3.6%. However, if you look at CPI in blue, it has started moving sideways, right? And the descent in core CPI in gray has certainly been slowing as well. That descent has been slowing. And that's because there is an area of inflation that remains somewhat elevated, and that is core services, which is mostly made up of shelter costs, medical costs, and transportation costs. And these areas have not come down as quickly as was forecasted and certainly remain sticky. So if you go to the next slide, this is an illustration of kind of what I'm talking about here. The different colored bars represent different areas of inflation and the contribution to those monthly inflation readings that we get. So back in 2021 and during the first half of 2022, toward the middle of the chart, you can see price pressures were widespread with food, energy, core goods, core services were all kind of contributing to inflation that was running way too hot. However, over the last year or so, some prices we've seen falling in areas such as core goods in purple. Energy in red also had a pretty long stretch of lower prices. But in the yellow bars, that represents core services and are really dominating, the contribution to the consumer price index or CPI. Essentially, it's nearly all of the remaining inflation in the economy. Services do take time for these areas to come down. Auto insurance, for example, tends to follow auto prices with a significant lag. CPI rents also lag actual market rents by quite a bit, but we have seen, auto prices coming down, rent prices have come down. So eventually we do expect this easing to flow through to the inflation data. But as you can see on this chart, the bottom line is that, core services has remained and remains a problem for the Fed, and it's making it difficult for our central bank to kind of get that final move lower in inflation back to its target. And really, this is one of the reasons, why the Fed has kept the Fed funds rate at the peak level of over 5.3% for the second longest stretch on record.
Thank you, Steve. We'll pivot here and maybe show our clients what that all means, right, from a portfolio positioning standpoint. So the illustration here shows segments of the market we are currently emphasizing or de-emphasizing in a client's portfolio. So to start with, from an asset allocation standpoint, we are currently neutral stocks relative to bonds. As Steve and Brandon showed earlier, stocks easily outperform bonds over the past 10 years, and that's a trend that our clients have benefited from as we've been overweight stocks more often than we've been underweight. As we look forward, however, we need to recognize that high interest rates have made bonds and cash reasonable alternatives to stocks. So said otherwise, investors today do not need to take as much equity risk as before in order to generate good returns. So for that reason, and other ones as well, we are currently not favoring one asset class over the other in clients' portfolios. Within equities and fixed income, and you can see it on the chart, we do have areas or segments of the market that we prefer over others. But in the interest of time, instead of going through the list here myself, maybe I'll ask Steve and Brandon to tell us what they're most excited about, what area or segment of the market they think will do really well in the coming quarters and years. So Brandon, let's start with you.
Yeah, so one area within equities that we like is US small caps. So small caps have certainly struggled relative to large caps going back nearly a decade now. And more recently, the pressures from higher interest rates have been a headwind for small caps, as they are typically more sensitive to the external financing costs. However, looking forward, the direction of interest rates is likely lower, and their valuation discount to large caps should create a good long-term investing opportunity. And we expect this relative performance to reverse once earnings growth returns, which is something that we illustrated is something that we're optimistic about going into next year.
Steve, when it comes to fixed income, I think it's hard, again, not to be excited about bonds in general, given where yields are today. But what area, again, or segment of the fixed income market excites you the most right now?
Yeah, thanks, Yan. If you move to the next chart, the shaded area on this chart shows the range of interest rates that we've been in over the last 15 years. The three lines are the yield curve, plotted at different points in time. So it's important to recognize where current rates are, compared to where we have been historically. The yield curve on January 1st of 2022 was toward the bottom end of the 15-year range. That's the lower line. On that curve, you had the 2-year Treasury yield at 0.7%, and you had the 10-year yield at 1.5%. So in a very short period of time, rates and along with rates, forward-looking return assumptions have all adjusted significantly higher. And the blue line towards the top of the 15-year range is the current yield curve as of last week. So across the yield curve, interest rates remain very attractive, where savers are really getting paid, very high rates of return in risk-free securities. Currently, the 2-year Treasury yield is almost 5%. The 10-year yield, today has moved back across or above 4.5%. On top of that, when we look at history, when the Fed has paused rate hikes and expectations are starting to build for, easier policy, bonds have typically posted pretty strong returns as, the pressure of rising rates fades and you accrue those higher coupons and higher interest rates. So with those rates at the highest levels in 15 years, plus the outlook for easier policy going forward, that combination, should provide a nice tailwind for high quality bonds really and continue to drive, attractive returns over the coming quarters.
Thank you, Steve. Thank you, Brandon. Okay, as we come to the end of today's webinar, 11:28 here, let's quickly recap. First, we discussed the performance of stocks and bonds. We then explored how artificial intelligence, consumer and fiscal spending have impacted both growth and inflation, and concluded with a review of how to best position portfolios given the current landscape. We certainly hope you found the webinar informative. Steve, Brandon, I want to thank you again for your time and your insights today. And to you all, thank you again for attending. Have a great day, everyone, and we'll see you next time.